Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 291 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvely, bring you everything you need to know from the past week in the world of financial markets and financial planning. Nick Whitaker, our Director of Research and Trading, is filling in for Matt this week since he is out. So welcome back, Nick.
Thank you. Good to be here as always.
I think you actually have been on the podcast more recently than I have, but I haven't been on with you here in a few weeks, so it's always good to have you back.
Yeah, it's been a while since the two of us have done one, so this will be fun.
Yeah. No shortage of things to talk about this week, so we will get into all of that here in a few moments. But before we get into this week's show, listeners, if you've been enjoying the Independent Advisors Podcast for a while now and want to take the next step in your financial journey, I'd encourage you to head to our website, jessupwealthmanagement.com. Matt offers a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at jessupwealthmanagement.com, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. So if you're ready to learn more, visit jessupwealthmanagement.com and book your call today. As always, we will quickly review the month-to-date and the year-to-date performance of the major market indices that we track. This data is from YCharts and as of the market close on March 12th. S&P 500 index down 6% for the month of March and down 4.8% on the year. The Dow Jones Industrial Average down 5.7% for the month and 2.8% for the year. The Nasdaq Composite Index down 6.4% for the month and down 8.6% for the year. And the Russell 2000 Small Cap Index down 6.3% for the month, down 9% for the year. And the Vanguard All World Ex United States ETF is up 1.2% for the month and up 6.8% for the year. 3-month Treasury rate at 4.35%, the 2-year Treasury rate at 4.01%, and the 10-year Treasury rate at 4.32%. Moving on to big headlines and current events from this week. A lot of tariff-related news headlines, Nick. So on March 4th, the U.S. enacted 25% tariffs on most goods from Canada and Mexico, and an additional 10% tariff on Chinese imports. 2 days later, it rolled back some of the tariffs on Canada and Mexico, but kept the tariffs on China in place. So on March 6th, President Trump paused the 25% tariffs on goods covered by the U.S.-Mexico-Canada agreement and automobiles until April 2nd. But then the administration implemented a 25% tariff on all steel and aluminum imports effective March 12th. And that last but not least, the European Union placed a 50% tariff on, I believe, American whiskey, in which the U.S. responded by saying if the tariff is not lifted immediately, the U.S. would impose a 200% tariff on all alcohol from the European Union. So if you are a lover of French wine or Italian wine, this might pose a problem. But again, by the time you listen to this, all of this tariff information that I just went over might be out of date and not good anymore, because this stuff is changing every single day, and daily, it seems several times a day. But again, Nick and I are going to talk about a couple of things related to this throughout the show, but it's really important to remember that we need to keep our focus on the long term and not get caught up in the short term media headlines. We saw this during Trump's first term. I think I saw a post on X earlier this week that someone brought back what they call the Trump tweetometer, which is tracking how many times he's tweeting per day and yada, yada, yada. And it shows, when he tweets more per day, the stock market's not doing well and all this stuff. But we're going to continue to see this throughout his 4 years in office, right? So I'm not telling people to get used to it. I'm just saying it's not going away. Yeah. And I feel very strongly that just like his first term, stocks are going to do just fine. There's going to be volatility over the short term like there is with any president in office. But, we just, again, have to keep our focus on the long term. And I know it's hard to do during times like this, but it is helpful during these times. So before I move on to some tweets, articles, and research, any thoughts on the topic?
No, that covers it pretty well. I would say, I think it's safe to say everyone has heard about this in one form or another. The news is pretty heavy on it, and regardless of what news you're consuming, I'm pretty sure that the coverage is terrific.
Very nice. Yeah. Love that you slid that in there.
Yep, that's really all I wanted to do was slide in that pun. So
did you have that one planned, or
as soon as you started talking, it popped in my head. So.
Very witty from Nick Whitaker. Tweets, articles, and research from this week. The first thing I had, Nick, and again, I had a bunch of stuff here, so we are going to talk more stock market related today and skip the financial planning topic of the week, but I think it's prudent given everything going on in markets over the past couple of weeks. So the first thing that I had was a post on X from Jesse Cohen on March 6th. And again, everything that we talk about here, Jenna will throw up relevant charts on the YouTube page for people that are watching. And she will also put all of the links to the things we're talking about in the show notes for the podcast if you were just listening via audio. So Jesse says this chart is fascinating. It shows the S&P 500 from 2018 to 2019 during the first Trump trade war in green versus the S&P 500 2025 during Trump War 2.0 in red. Will history repeat? And it shows this chart like he explained, and the market in the Trump Tariffs 2.0 so far has acted very, very similar to the first round of tariffs during his first presidency. Now, I think it's really important to point out that the green line in this chart, or the tariffs implemented in Trump's first term, represents approximately March 8th of 2019 through December 11th of 2019. Mm-hmm. So it's just about a 9-month period. So this is not like a year to date, 2016 reference to 2025. It just so happens that, Trump Tariffs 2.0 happened in the very beginning of his second term in office. But I don't want people to get this misconstrued, because the first time I looked at this chart, I was like, okay, like, what does the start of 2025 look through the first couple of months? And I went back to 2016 or 2017 and said, what did the first couple of months of 2017 look like? And it didn't look like this chart on the screen. So I was like, what's going on here? And what Jesse did was, he fit the chart to where the tariff announcements and the tariff related media headlines were coming out in the first term and in the second term now. So again, he chose this time period just because there were several new tariff announcements in May and August of 2019, which coincided with market pullbacks. So again, I just thought it was an interesting chart, and if nothing else, just to say we've been through this before.
Yeah, absolutely. It is quite a fascinating chart, which Jesse points out here, and I think the way he does that is I think the best way to do it, where he's focusing more on what's the driving forces, so to speak, which is why the timelines are mismatched, if you will. But if you recall, and there's been some chatter about that the past month, couple months, I guess, with Trump coming into office the first time. It started a little bit more with taxes and some of the benefits, and this time it's starting more with tariffs. And so the market has been a bit uneasy about that, which is why you're seeing, that those timelines are not the exact same. It's because the order is different, and this is a slightly different time. So either way, fantastic chart.
Yeah, and something, even though Matt's out, I was talking to him yesterday for a little bit about, some things that were going on. If anyone saw the interview or press conference recently given by Trump, it might have been in the State of the Union speech where he said, said something along the lines of, we're willing to go through some rough patches to get to where we want to be, alluding to maybe the stock market doing well or the economy not doing well. But at the end of the day, based on what we know about him, part of his legacy in office is how well the stock market and the economy do. And he's aware of that, right? So I think he will have a breaking point or a cry uncle point where it's like, okay, like we need to, do some things to turn this around, because he's not going to let the market be unbelievably weak during his whole second term in office. I just don't believe that. That's a personal opinion, but I thought I would share that with people.
I agree.
Second thing I had was a post on X from Ryan Dietrich on March 5th. So he says, according to sentiment expert Ed Clissold, the NDR, or Ned Davis Research Daily Trading Sentiment Composite, is down to 20, suggesting extreme pessimism. 1 month later, the S&P 500 has been up 80% of the time and is up a median of 4%. So the NDR Trading Sentiment Composite Indicator is a tool that's used to measure kind of the mood of short-term traders in the market. So it combines multiple sentiment indicators. So things such as options trading activity, investor surveys, and market positioning to gauge whether traders are overly bullish or optimistic or bearish or pessimistic. And if the indicator is very low like it is now, it does signal excessive pessimism, which could indicate a buying opportunity not too far away as the market is oversold. But again, just kind of like any of the other sentiment indicators that we've talked about on the show here over the past couple of years, whenever things reach an extreme level in terms of people being absolutely bearish, it's usually a pretty decent contrarian indicator. Not saying it has to happen immediately, but again, when people are the most negative on the market, when they're buying the most protection to protect their portfolio against any further fall, like we're kind of seeing right now, and we have seen over the past couple of weeks, usually, from my experience, we're getting closer and closer to a market bottom, or at least a short-term market bottom, where we see some sort of a relief rally of several percentage points to the upside in the main market indices. So I just thought that this was interesting. This, again, is not the only sentiment indicator that is saying this right now. So, questions we've been getting a lot over the past week, as people can imagine, is, hey, when are we going to get this market bottom or short-term market bottom? And my feeling is we're getting closer and closer to that over the next week or two.
Yeah, we talked about negative sentiment, I think, a couple weeks ago. I'm pretty sure Matt had something on that as well. So this has been going on for a couple weeks now. So not really surprising to see. And a reminder that sometimes the best buys hurt a little bit to buy.
Yeah, it does. It does. It doesn't feel good, buying names that are 20 or 30% off the highs like they are now. But it's not supposed to feel good either. You're supposed to be second guessing. Should I really be, be buying this? And I know Matt's talked about that a lot on the show. But it's part of it, right? And to be clear, sentiment could get a lot worse. It could get a lot more bearish than it is right now. And it's not a foregone conclusion. I feel like I've been using that term a lot lately. A foregone conclusion that we are going to get a market bottom over the next week or two. We're just using the data that we have and looking back at history and saying, hey, in the past, this has tended to happen, type of thing. So next thing I had was a post on X from Jason, Three Peaks Trading, on March 4th. So he says insiders are buying this market pullback. The past 2 days saw more insider purchases since the December dip. So this is a chart of insider buy sales for officers and directors of publicly traded companies. So again, when I'm talking about insiders buying stocks, I'm talking about CEOs, CFOs, board of directors of publicly traded companies. And this is often referenced as the smart money sometimes. So we do want to take note of when corporate insiders are, number one, buying shares of their own stock, and number two, just buying into the market in general, because like we've talked about before, people only buy for one reason. They think that stock, that bond, that security, that index is going to go up, right? Mm-hmm. They can sell for any number of reasons. They need to buy a house. They need to pay for college. They're taking a big vacation. They're buying a yacht. People sell for multiple different reasons, but they only buy for one reason. And to back this up even further, I was looking at some research from Sentiment Trader, who we've mentioned on this podcast before, and specifically based on their data, technology sector insiders seem to be gobbling up a lot of their own stock right now, which I think is interesting because the tech sector obviously has gotten hit the worst. Mm-hmm. But again, if these people have access to information that me and you don't have access to your average retail investor does not have access to. And these companies have done a pretty good job of predicting the future and what their future is going to look like. That's why they provide guidance on their financials during, earnings season, right? Mm-hmm. For the next quarter or the next year, how they think they're going to do. And a lot of times they're pretty spot on. I don't think they would be buying stocks right now if they thought Armageddon is 6 months away.
This is a bullish chart.
100%. Again, there's people out there calling for the top. I don't think you'd be seeing this type of bullish behavior from some of the smartest people in the world with access to information that not a lot of people have.
On the inside,
I don't think they'd be, lighting money on fire like this.
Right, exactly. Yeah, I agree.
Is the best way to say it.
And another way to think about it is these corporate insiders who again, they are insiders. They know more. Tim Cook knows more about Apple than anybody else, right?
And to be clear, these insiders have restrictions on when they can buy and sell
they
the
have
stock.
blackout periods and whatnot.
Right. So they can't just, once they know what their earnings are, they can't go and act on that immediately, right? So
yeah, absolutely. But another way to think about it is they think they're getting a discount. Mm-hmm. They think they're getting a discount, so they're buying now because they think, hey, this is awesome. I can I can buy now. So this is for anyone who's really concerned about tariffs and the market and the recent market action. This should make you feel a little better.
Yeah, and now that you said that, it brings back a quote that I've seen several times over the past couple of years is something along the lines of the stock market is the only place where things go on sale and everybody runs out of the store, right? Which is really interesting from an investor psychology perspective because I fall privy to this too. Like when there's a sale at a certain store I like, if they're, new golf shirts or golf pants or golf shorts or something, I'm the first one to go look and see what they have, right? Yeah. But it's just kind of interesting that it doesn't really work like that for most people in the stock market.
No, it does not.
So, fourth thing that I had was a post on X from the Daily Chart Book on March 4th. So they said this: in the first 2 months of the year, the S&P 500 has followed its typical pattern for the post-election cycle. And it's a chart from Grant Hawkridge showing in blue the average performance for the S&P 500 during post-election years or the year after a presidential election. So the blue line is that average going back to 1950, Nick, and the red line is the performance of the S&P 500 so far year to date, or I think it's through the end of February. But again, it's tracking pretty normally to how most post-election years play out in the first quarter. We had strength in January and the first half of February, which is normal, but then the second half of February and the first part of March has been really weak. And as you can see, that's normal, right? And it's something we have to remember that, the first quarter of a post-election year is the second weakest quarter out of the entire 4-year presidential cycle. So just put that into the perspective. The weakest quarter is sometime during the midterm year, which in this case is going to be 2026. So if this was a situation where, usually the first quarter of post-election years, or just the first quarter in general, was usually really strong and markets average being up 7% in the quarter, and we were getting this type of action, that might make me scratch my head a little bit more and say, hey, something might be going on here. But so far, Nick, what this chart tells me is that this is just normal seasonal behavior. And yes, the year-to-date performance, it went higher than the average performance in the beginning of January and early February, and it's dropped, quicker and more violently than what the average year has done in post-election years since 1950. But the trend is more important than the actual percentage moves when you're looking at a chart like this. And so far, there's nothing. If all I had was this chart and no other data, I would say, this is just par for the course type of thing in the first quarter.
Absolutely. And just a data observation is the blue line and the red line, whatever red line you're plotting on there, whether it was this election cycle or a single individual election cycle from, 4 presidents ago, you would expect that red line to have more volatility because it's a single data point as opposed to averaging all of the data points from 1950 to 2021. So the fact that it is so close, even though it's a single data point, is also quite telling to me.
Yeah. So. Yeah, for sure. All right. Last thing I had was another post on X from Charlie Bilello on March 3rd. So he says the S&P 500 fell 1.8% today. Again, this was March 3rd. Its biggest decline of the year so far. This was the 6th daily decline in 2025 with a loss above 1%. Since 1928, the average year has had 29 such declines. As an investor, you should expect many more days like today. So pretty simple chart there from Charlie. It shows each year the number of 1% down days, the number of 2% down days, the number of 3% down days. And we can kind of get an average of, how many days in the market should we expect in 2025 where, we have a down day of greater than 1%. And I bet that number of averaging 29 per year is more than people think initially. But again, it is pretty common. Like we always say, volatility is the price we pay to get above risk-free rates of return in the stock market.
Yeah, I think we can look at this chart with perhaps a bit of gratitude that the volatility in general of the market has seemingly come down quite a bit and since decades past. Mm-hmm. You look at the 40s and the 50s, really early 40s, and then even getting into the 70s as well, there's been much more volatile times than what we've dealt with the past decade. Mm-hmm. So, again, just a little observation there. Because a 1% pullback is, that's, as you can see on the chart, that's pretty normal. You're going to see quite a few of those. But the 3% pullbacks, those ones hurt. And,
And, one of the things to look at, Nick, to see, how much longer this consecutive streak of, 1% plus moves in the market in either direction is going to last is a simple rule is just to take the VIX, which is the volatility index, the expected volatility in the S&P 500 over the next 30 days. And you take the VIX and divide it by 16. So if you have a VIX at 32, for example, you divide it by 16, that gives you 2. You should expect 2% daily moves in the market while the VIX remains at that 32 level. So as long as volatility stays elevated, we should continue to expect these big swings in either direction. But just over the past couple of days, the VIX has gone from low 30s or high 20s down to the mid 20s, low 20s. So if that downward trajectory continues, then I would expect over the next couple of weeks that the large amount of these price moves in the market will start to decrease as well.
Yeah, and the VIX moves fast. It moves
quick.
It moves very quick for listeners who are unaware. Yeah, I mean, just looking at, and I'm obviously staring a hole in this data because it's interesting. Yeah, obviously 2022 is a bad year, and 2020 was obviously some scary times, and you have the total 1%, 2%, 3% pullbacks at 45, but recall that year ended massively positive.
Yeah, it was great.
So yeah, looking at numbers in the 20s is extremely normal. So yeah, it's a good chart.
Yeah, thought so too. I will turn it over to you.
Yeah, I just have two kind of quick pieces here. The first one is just a recap on what are the driving forces, and a lot of it is tariffs, as we've talked about. But this is from a briefing.com research piece called The Big Picture. I actually think I talked about this 2 weeks ago as well. This is a new release on the 7th of March. And I thought that he had a good just kind of recap of what's driving the market, and particularly the price action in the market, just so I thought listeners might enjoy this. So I'm just going to read this. In a nutshell, the stock market hasn't liked the tariff news. It hasn't liked the cadence of the announcements, which has injected added uncertainty for companies trying to make investment decisions. And it hasn't been convinced, it being the market, and the market hasn't been convinced these tariff actions won't lead to higher inflation and or weaker growth. That's what's driving the market. Its misgivings has manifested themselves in the following way. The counter-cyclical healthcare and consumer staple sectors have exhibited relative strength. That's a risk-off move. We would expect that. The consumer discretionary and financial sectors have underperformed. That makes sense as well. There has been a stark unwinding of momentum trades. A lot of that's going to be profit-taking from your tech. Makes perfect sense. The treasury market has rallied, driving yields lower. Reminder to listeners who don't know, as you buy bonds, the yields go down. So people buying bonds is rotating out of stocks or maybe taking some cash and putting into bonds. Again, that makes sense. The dollar has sold off. That makes sense. Oil prices have weakened. Makes sense. And the Fed funds futures market has priced in the likelihood of 3 rate cuts in 2025 versus 2 only a short time ago, which I think in the long run, the market's going to like, right? So that's kind of a little positive thing. So I think everything that we've seen from a textbook kind of trade perspective is very normal. There's not anything that jumps out that I look at and I'm thinking, oh, that's kind of a funky move with increased volatility and the global economics around tariff news. This is what you would expect. So
yeah, I would agree. I think that was a pretty good synopsis of what's going on. So we'll have to keep our eye on that, and we just got the one of the things you mentioned was the fear of inflation reigniting. We just got the most recent CPI report yesterday and came in cooler than expected.
Yeah, looks
which
good.
is good, which could have contributed to a lot of the rally that we saw in the market yesterday. So on the inflation standpoint, obviously the market would like to continue to see those monthly reports come in pretty cool, or else, it would just kind of add fuel to the fire, so to speak, on the tariff conversation.
Absolutely. And the last piece I have is just a quick reminder. We've talked obviously a lot about just the market movement and, what to expect and what we've seen in the past. This is just a chart reminding listeners that market corrections are very normal. And as investors, in a lot of ways, we welcome them because, as you mentioned many times on the podcast, if there are no market corrections, then the market is not behaving rationally and normally. So this is a research piece from Charlie Bolello as well. Shout out, Charlie. We love your work. This is on the 11th, 3/11. And he says the S&P 500 has now fallen over 9% from its peak on February 19th, the biggest pullback since last August. This is the 30th correction, greater than 5% off of a high since the March 2009 low. They all seem like the end of the world at the time. And that's what I want to just focus on, is they all seem like the end of the world at the time. And they do. They all feel like, ooh, this hurts. It's not fun to watch. But if you look at this chart, and we'll throw it up here, the thing I want to point out is it happens almost annually. We can expect this almost annually. There are a few years in here that we got to skip it, and it was just a really fun, jolly ride upwards. But again, looking at history, that's not normal. So seeing these pullbacks, as I mentioned, and as we've mentioned many times on the podcast, this is normal, even welcome at times.
Yeah,
you get a discount, right?
Yeah, you get a discount. Yeah,
Stocks are on sale.
Shouldn't be running out of the store, depending on your time horizon and just tolerance, of course. But no, it's a great chart. We show a similar chart to clients during meetings that it's an actual chart of the S&P 500, and along the way since the early 1900s, it shows all of the horrible things that have happened in the world, and the market's been able to overcome every single one of them. So I don't think we should think anything different this time.
Yeah.
So
and most of it is sentiment driven, and it's just a bit of profit taking, and basically the market's saying, hey, we don't love the narratives that are out there right now. We can't really predict exactly what's going to happen, or we don't feel great about what could happen in the next 3, 6, 9 months, a year. And so you have a bit of a pause and a bit of profit taking. And some of the big institutional money says, you know what, we're just going to sit here for a second. Let's see how this shakes out. And that just drives bids lower, and the market pulls back. And that's if you run down this list and read, you see fears a lot in it, right? Which is just a sentiment piece.
Well, I'm glad that you brought that up, because this was another thing that I was talking to Matt about yesterday, and he was asking me, from the data that you're looking at, what's your opinion on this? And my opinion is pretty much this entire sell-off, especially in tech, has been sentiment driven. And what I mean by that is that the financial position of these companies have not gotten any worse than they were 3 months ago.
Yeah.
Right.
Yeah.
They're not projecting lower earnings growth. They're not projecting lower margins or revenue growth. Everything's pretty much the same as it was 3 months ago. And to me, it's like, well, if a company's financial position has not changed, or it's even gotten stronger, and people are still selling off stocks, then that's a sentiment-based sell-off. People are just bearish without the fundamentals to back it up. Right. It'd be a different story if a company like Google, Amazon, Apple, Microsoft was like, hey, we're going to be slowing sales and earnings growth over the next couple of years. That's different. That's a fundamentally based sell-off.
Right.
Again, so to me, so far, and I think a lot of people are highly anticipating earnings season already based on this sell-off to see if these companies change their tune. But so far, we haven't seen any data to suggest that the financial position of most of these large publicly traded companies has deteriorated.
Yeah, particularly in the tech sector, you can always find examples of there are a lot of companies out there, of course. There have been a few that have come out and had some negative headlines and some.
But I'm
negative
talking about the juggernauts, right?
Yeah, the juggernauts, that's not the case. But if anyone's catching the headlines about like the airlines, for example, the airlines have come out and said, but that's not the market norm. By no means is that. When you look at all of corporate earnings, let's just take 500 of them, 500 the S&P. The norm is not what the airlines are saying, right? That's a little bit more on the fringe, I guess you could say.
Right.
Yeah. Some of the consumer discretionary names have some of them, not all of them.
Okay. Well, if you don't have anything else, Nick, we're going to go ahead and leave it there for the week. So just want to thank everyone again for listening to episode 291 of the Independent Advisors Podcast. We will be back with you next week for episode 292.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.